I'm 95 years old, people still line up to ask me the same question. Warren, what stock should I buy right now? After all these years, that's still what most people want, a hot tip, a clever trick, a shortcut. So let me disappoint you right at the start. If you're hoping I'm going to whisper the name of some obscure company that will 100 times your money in 12 months, you're going to hate this video. Because for the vast majority of people watching this, the smartest thing you can do with your money is so simple, so dull, and so repetitive that you'll be tempted to ignore it. And yet that boring thing will beat almost everyone who's frantically trading, watching charts and refreshing their portfolio 12 times a day. Here is the get-rich-slow scandal in one sentence. Take most of your money, put it in a very low-cost S&P 500 index fund, add to it regularly, and leave it alone for 40 years. That's it. No fireworks, no secrets, no cleverness required. And that's exactly why almost nobody does it. Why I told my own family to buy one boring fund when I die. Most of my estate that goes to my wife and family is not going into some complicated hedge fund or secret Berkshire strategy. In my will, I gave the trustee one simple instruction. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I even suggested Vanguard by name. Think about that for a second. I've spent my life analyzing businesses, reading annual reports, buying and holding great companies. People call me the Oracle of Omaha and treat stock picking like some mystical art. And yet, when it comes to my own family's money after I'm gone, I'm not telling them to pick stocks. I'm telling them to buy a boring index fund and forget about it. Why? Because I know something most people don't like to admit. The average investor is terrible at stock picking. Most professionals don't beat the market either, especially after fees. So you can spend 40 years chasing tips and expert opinions and clever strategies, or you can quietly own a slice of the 500 biggest, strongest companies in America at almost no cost and let the country's productivity work for you. Guess which one wins 9 times out of 10? The only number you actually need to understand. Let's talk about one number. Historically, over long periods, the U.S. stock market, measured by something like the S&P 500, has returned about 10% a year on average before inflation. Not every year. Some years are terrible. Some are wonderful, but over decades, that's the ballpark. Now watch what that does if you simply buy a low-cost S&P 500 index fund, reinvest the dividends, add a fixed amount every month, do nothing else. Let's say you're a 25-year-old watching this and you invest $500 per month into an S&P 500 index fund for 40 years. With around 10% average annual returns, here's roughly what happens. After 10 years, you have somewhere over $100,000. After 20 years, you have roughly $340,000. After 30 years, it's getting close to $900,000. After 40 years, you're in the range of $2 million. No options, no leverage, no margin, no crypto, no complicated products. Just one low-cost S&P 500 index fund and a monthly contribution you could easily waste on things. You won't even remember next year. If you double that to $1,000 per month and keep going for 40 years, you're looking at results in the multi-million range on perfectly ordinary market assumptions. This is the scandal. The math is public, the instrument is public, the instructions are public, and still almost nobody wants it because it works slowly. Why almost everyone prefers to lose the hard way people say they want to be rich. What they really mean is they want to feel excited. They want drama stories, a sense of being smarter than everyone else, a big payoff soon. Compounding doesn't look like that. Compounding looks like watching paint dry for 10, 15 years, and then suddenly your money seems to explode in the last decade. Here's a simple truth about my own life. More than 90% of my net worth showed up after I was already past middle age. Not because I found some magical stock late in life, but because compounding finally had enough time to do its work. Most people never get there because they keep interrupting it. They jump in and out of the market based on headlines. They chase hot stocks when they're already expensive. They sell at the bottom because they can't take it anymore. They pay high fees to managers who underperform the index anyway. They're not investing. They're entertaining themselves with their own money. The boring plan for the next 40 years. If I sound bored when I explain this, it's because the plan really is boring. Here's what I would tell a normal person who wants to retire wealthy and doesn't enjoy turning their life into a full-time trading desk. Pick one low-cost S&P 500 index fund, something that tracks the broad U.S. market with very low fees. Vanguard, Schwab, eShares, pick a reputable provider, but focus on low cost. Automate a fixed monthly investment. Decide an amount that hurts a little but doesn't break you. $300, $500 a month. Set up automatic contributions so it happens whether you feel like it or not. Reinvest the dividends. Don't pull out the cash flow to buy toys. Let the dividends buy more shares, which generate more dividends, which buy more shares. That's compounding. Ignore the noise. Do not check your account every day. Do not change your plan because of elections, wars, recessions, or what your cousin said at dinner. The economy will have problems every single year. Your job is to keep buying anyway. Do this for 30, 40 years, not 30, 40 days, not until the market looks scary, for your entire working life. If you can't tolerate seeing your account fall 30, 50% on paper a few times over those decades, you shouldn't own stocks at all. That's just the price of admission for the long-term return. What about individual stocks? Isn't that what you did? Yes, I picked individual stocks. Yes, it worked out well. But you have to understand the context. I read annual reports for fun. I've spent 80 years doing practically nothing but analyzing businesses. Even then, I made plenty of mistakes. When I recommend a low-cost index fund to normal people, I'm not insulting them. I'm respecting the fact that they have jobs and families. They don't have 8 hours a day to study companies. They don't want to lose sleep over every earnings report. Most people trying to pick stocks are competing in the Olympics after jogging 3 times a year. They'd be far better off owning the entire index and getting on with their lives. The real scandal, simplicity, works, but only if you let it at 95. Here's what I can tell you with a straight face. If you save consistently, put your money into a low-cost S&P 500 index fund, reinvest your dividends, ignore the crowd, let 3-4 decades pass, you will be doing better than most people who spend their lives chasing the next hot thing. You won't have an exciting story to tell at parties, but you'll have something better, the freedom to ignore bosses. You don't like the ability to take care of your family, the luxury of not worrying about the next correction. The scandal isn't that getting rich is complicated. The scandal is that it's simple and almost nobody has the patience to do it. Stop asking for stock tips. Do the boring thing. Own the index. Add regularly. Wait, you'll be amazed what 40 quiet years can do.